Big Four Valuations. Interview Preparation. Welcome back to the channel. Today we dive into how Big Four teams approach valuations, from DCF to market multiples to intangible valuation. These questions come straight from real interview patterns across Big Four valuation teams and global transaction advisory practices. Let's begin. How do you determine which valuation approach, DCF, market, or asset, is most appropriate for a business? Sample answer. I start by understanding the nature of the business. If it has stable and predictable cash flows, I use DCF. If publicly comparable companies exist or recent deals are available, I use market or transaction multiples. If the business is asset-heavy or generating weak earnings, I consider asset-based valuation. The choice depends on business model, data availability, and valuation purpose. While answering, always talk about business characteristics, data availability, valuation purpose, cross-checking approaches. A company has volatile cash flows. How do you normalize cash flows for valuation purposes? Sample answer. I review historical financials, remove one-off gains or losses, adjust for abnormal working capital swings, and smooth out cyclical fluctuations. I also adjust margins to industry norms where relevant. The goal is to estimate a sustainable base year cash flow. While answering, always talk about removing anomalies, smoothing cycles, adjusting margins, establishing sustainable base. How do you calculate WACC for a company operating in multiple countries with different risk profiles? Sample answer. I first determine country-specific risk premiums, tax rates, and leverage norms. I compute cost of equity separately for each geography, apply weighted average based on revenue or asset exposure, and adjust cost of debt for local borrowing conditions. Then I aggregate into a blended WACC. While answering, always talk about country risk, local capital structure. Blended calculation, sensitivity, odd. A business has negative working capital. How do you factor this into valuation? Sample answer. Negative working capital can be normal in some industries, like retail or SaaS. I analyze whether it's structural or temporary. If structural, it enhances free cash flow. If unsustainable, I adjust for future working capital needs. While answering, always talk about business model, sustainability, impact on FCF, adjustment needs. How do you select comparable companies for a trading multiples analysis? Sample answer. I look for similarity in business model, size, growth, margins, geography, customer base, and capital intensity. I exclude outliers, highly diversified companies, or distressed players unless explicitly relevant. While answering, always talk about similarity filters, size and growth alignment, removing outliers, ensuring relevance. A client questions why EBITDA multiple differs between precedent transactions and trading comps. How do you explain the gap? Sample answer. Transaction multiples typically include control premium, synergy expectations, and deal competition, making them higher. Trading comps reflect minority market pricing and daily sentiment. Both serve different purposes. While answering, always talk about control premium, synergy expectations, market sentiment, purpose differences. How do you treat non-recurring or one-off items when performing a DCF valuation? Sample answer. I remove one-offs from historical cash flows and adjust base year EBITDA accordingly. I ensure projections exclude such items unless they recur strategically. While answering, always talk about cleaning history, adjusting base year, validating projections, maintaining consistency. A company operates in a niche sector with few comparables. How do you approach valuation? Sample answer. I broaden the universe using adjacent industries, adjust multiples for risk and growth, or rely more heavily on DCF. I may also use SOTP or rule of thumb metrics when appropriate. While answering, always talk about expanding comparables, adjusting risk, leaning on DCF, validating ranges. How do you adjust beta for unlevered and relevered capital structures? Sample answer. I unlever industry beta using 1 plus DE times 1 tax rate, and then relever using the target's capital structure. This reflects true business risk separate from financing choices. While answering, always talk about removing financing impact, applying formula, aligning to target leverage, risk accuracy. How do you determine terminal growth rate and test for reasonableness? Sample answer. I align terminal growth with long-term GDP growth, industry maturity, and inflation trends. I ensure it's below long-term economic growth and test sensitivity on valuation. While answering, always talk about macro alignment, industry maturity, economic constraints, sensitivity checks. A startup has no profits and minimal revenue. How do you value such an early-stage business? Sample answer. I focus on TAM, achievable market share, unit economics, burn rate, and milestones. I use VC methods, scorecard methods, or probability-weighted expected returns. While answering, always talk about market potential, unit economics, milestone risks, alternative methods. How do you evaluate the impact of customer concentration risk on valuation? Sample answer. I assess dependence on top customers, evaluate churn likelihood, check contract duration, and discount valuation multiples if risk is high. While answering, always talk about dependence, churn risk, contract strength, valuation adjustment. A company recently changed accounting policies. How do you ensure comparability in valuation metrics? Sample answer. I restate historicals for consistency, adjust EBITDA and cash flows, and reconcile policy impacts to ensure comparability with peers. While answering, always talk about restatement, reconciliation, EBITDA comparability, peer alignment. How do you assess valuation impact of contingent liabilities or pending litigations? Sample answer. I quantify potential outcomes, probability weight them, adjust cash flows or equity value, and reflect risk through discount rate adjustments if necessary. While answering, always talk about probability, financial impact, cash flow adjustment, disclosure needs. How do you value intangible assets such as brand, patents, or customer relationships? Sample answer. I choose methods like relief from royalty, brand, multi-period excess earnings, customers, or cost replacement, technology. I estimate useful life and risk-adjusted discount rates for each asset. While answering, always talk about selecting method, projecting benefits, discounting risk, useful life. A company has seasonal revenues. How do you adjust financial projections? Sample answer. I identify seasonal patterns, adjust quarterly or monthly cash flows, and ensure working capital reflects seasonality. Annual averages alone aren't reliable. While answering, always talk about seasonality patterns, sub-annual modeling, working capital alignment, smoothing. How do you determine control premium and minority discount in equity valuation? Sample answer. I assess benefits of control, like strategy shifts, dividend changes, cost actions, and compare to empirical market studies. Minority discount is inverse of control premium. While answering, always talk about control benefits, empirical data, valuation impact, negotiation context. A firm is raising capital. How do you reconcile share valuation with investor return expectations? Sample answer. I calculate intrinsic value, compare to investor IRR expectations, model dilution, and test post-money valuation relative to growth plans. While answering, always talk about intrinsic value, investor IRR, dilution, growth feasibility. How do you assess synergies in a merger valuation? Sample answer. I break synergies into revenue and cost synergies, validate achievability, estimate integration costs, and convert net synergies into present value. While answering, always talk about synergy identification, achievability, integration costs, net value. A private company has no observable market data. How do you estimate cost of equity? Sample answer. I use industry betas, size premiums, country risk premiums, and adjust for firm-specific risk. I rely on fundamental risk analysis instead of pure market data. While answering, always talk about proxy betas, size risk, country premium, qualitative adjustments. How do you evaluate forecast credibility when management projections seem overly optimistic? Sample answer. I compare with historical accuracy, industry benchmarks, customer pipeline quality, and scenario test critical assumptions like pricing and volume. While answering, always talk about benchmarking, history versus forecast, pipeline quality, sensitivity. A business holds significant real estate assets. How do you factor asset values into valuation? Sample answer. I perform NAV analysis for real estate, compare carrying versus market value, and adjust enterprise value accordingly. I avoid double counting if real estate income is already in cash flows. While answering, always talk about market valuation, double count risk, NAV adjustment, reconciliation. How do you value a loss-making company expecting turnaround in 3 to 5 years? Sample answer. I model turnaround path, adjust early year losses, incorporate restructuring costs, and apply higher risk premiums. DCF relies heavily on terminal value in such cases. While answering, always talk about turnaround assumptions, restructuring costs, risk premium, terminal value weight. A target company has heavy debt. How do you differentiate equity value versus enterprise value? Sample answer. Enterprise value includes debt. Equity value deducts net debt. I am sure EBITDA and multiples align with enterprise value, while equity value reflects leverage risk. While answering, always talk about EV versus equity, net debt, consistency of multiples, risk allocation. How do you adjust valuation for currency risk in cross-border valuations? Sample answer. I adjust cash flows into functional currency, incorporate forex volatility into discount rate or sensitivities, and test downside scenarios. While answering, always talk about currency conversion, volatility impact, discount rate adjustments, scenario testing. A company has inconsistent historical CAPEX. How do you estimate normalized CAPEX for DCF? Sample answer. I start by understanding whether past CAPEX was maintenance-related or growth-driven. I normalize maintenance CAPEX based on industry benchmarks, asset age, and expected replacement cycles. If the company plans major expansion, I incorporate that separately as strategic CAPEX in projections. While answering, always talk about maintenance versus strategic CAPEX. Industry benchmarks, asset age, forward-looking needs. How do you value bonus shares, rights issues, and ESOPs for corporate actions? Sample answer. For bonus shares, I adjust equity value since total value doesn't change. Only the number of shares does. For rights issues, I calculate the theoretical ex-rights price. For ESOPs, I use Black-Scholes or binomial models to determine fair value based on volatility, risk-free rate, and vesting terms. While answering, always talk about share count impact, dilution effects, option pricing models, fairness of adjustments. A shareholder disputes valuation. How do you justify key assumptions and methodologies? Sample answer. I explain why selected methods fit the business model, show sensitivity tests, reference external market data, and demonstrate consistency with valuation standards. I walk them through each assumption transparently: growth, discount rate, margins, and provide alternative scenarios. While answering, always talk about transparency, external benchmarks, scenario comparison, methodology justification. How do you estimate discount rate for intangible asset valuation under relief from royalty method? Sample answer: I start from WACC and adjust upward for asset-specific risks like brand volatility, legal exposure, and competitive intensity. Since intangible cash flows are riskier, the discount rate usually ends up higher than the business WACC. While answering, always talk about asset-specific risks, volatility, industry competitiveness, adjusting above WACC. How do you value a company in distress or undergoing insolvency? Sample answer: I prioritize asset-based valuation, liquidation value, and distressed DCF with heavy discounting. I also assess recovery rates, operational viability, and restructuring potential. Market multiples are used cautiously because distressed companies distort comparables. While answering, always talk about liquidation value, recovery assumptions, viability assessment, deep discounting. A business segment is being carved out. How do you allocate corporate overhead costs? Sample answer: I analyze cost drivers, headcount, revenue, space usage, and allocate overhead proportionately. I also estimate standalone costs the carved-out segment will incur post-separation, which usually increases its cost base. While answering, always talk about cost drivers, allocation logic, standalone adjustments, post-separation overhead. How do you adjust multiples for differences in growth, size, and risk? Sample answer: I compare the target with peers and adjust multiples downward for lower growth or smaller scale. For higher risk, I apply a discount or shift to EV revenue, EBIT multiples that better reflect risk. While answering, always talk about growth differentials, scale impact, risk adjustments, choosing the right multiple. A target has large intercompany transactions. How do you normalize profitability? Sample answer: I review intercompany pricing, eliminate artificial margins, apply arm's-length pricing, and reconstruct true standalone profitability. This ensures valuation reflects what the business can earn independently. While answering, always talk about arm's-length principle, transfer pricing review, standalone profitability, reconstruction. Sample answer: How do you value a subscription-based SaaS business with ARR metrics? Sample answer: I focus on ARR, churn, LTV/CAC, gross retention, and cohort trends. DCF is built around recurring revenue and unit economics rather than accounting EBITDA. Market multiples often use EV/ARI or EV revenue. While answering, always talk about ARR, churn, cohort behavior, unit economics, SaaS-specific multiples. A PE firm uses IRR-based valuation models. How do you reconcile IRR versus DCF outcomes? Sample answer: DCF shows intrinsic value today, while IRR reflects investor return targeted at exit. I reconcile them by aligning exit multiples, leverage, and cash flow timing. Both should converge if assumptions are consistent. While answering, always talk about exit assumptions, leverage effects, timing of cash flows, consistency, alignment. How do you incorporate ESG risks into valuation? Sample answer: I assess how ESG factors impact margins, regulatory exposure, cost of capital, and long-term growth. High ESG risk may warrant higher discount rates or lower terminal growth. While answering, always talk about regulatory risk, reputational exposure, cost of capital impact, long-term sustainability. A company has large tax losses carried forward. How do you factor this into valuation? Sample answer: I estimate the period over which losses can be utilized, apply statutory limits, and adjust cash flows for lower tax payments. I also discount the benefit for uncertainty of future profitability. While answering, always talk about utilization horizon, profitability likelihood, tax savings, uncertainty discount. How do you value a company using SOTP, sum of the parts? Sample answer. I value each business segment separately, using appropriate methods for each, DCF, multiples, or NAV. Then aggregate and adjust for corporate costs and intercompany dependencies. While answering, always talk about segment-wise methods, aggregation logic, overhead deduction, cross-segment adjustments. A client disputes goodwill impairment. How do you evaluate impairment model assumptions? Sample answer. I review CGU allocation, test discount rates, check reasonableness of growth rates, and compare projections to historical performance. If assumptions are overly aggressive, impairment is likely required. While answering, always talk about CGU mapping, discount rate testing, forecast realism, regulatory expectations. How do you handle terminal value when the industry is undergoing structural decline? Sample answer. I use a declining terminal growth rate, sometimes even negative, and rely more on explicit forecast years. I may also consider exit multiples aligned with industry contraction. While answering, always talk about structural decline, negative growth, shorter forecast horizon, lower multiples. A startup issues convertible instruments, CCDs, CCPS. How do you value equity ownership? Sample answer. I model conversion scenarios, liquidation preferences, participation rights, and discount factors. Waterfall analysis helps determine implied equity value for each shareholder class. While answering, always talk about conversion terms, liquidation waterfall, rights hierarchy, scenario valuation. How do you adjust valuation for working capital fluctuations? Sample answer. I normalize working capital based on historical averages and industry norms. Sharp fluctuations are isolated and corrected in FCF forecasts to prevent distortion. While answering, always talk about historical patterns, industry benchmarks, normalization, cash flow accuracy. How do you evaluate management's sensitivity analysis and scenario projections? Sample answer. I check whether key drivers, price, volume, margins, WACC, have been stress tested logically. I rerun independent sensitivity tests to validate robustness. While answering, always talk about key drivers, stress testing, independent validation, realism. A company is expanding into a new market. How do you incorporate strategic growth options into valuation? Sample answer. I treat expansion as a real option, with probability-weighted scenarios for success, ramp-up period, and capital intensity. Option value is added to base case DCF. While answering, always talk about probability weighting, optionality, ramp-up risks, incremental value. How do you value ESOPs using Black-Scholes or binomial models? Sample answer. I input volatility, risk-free rate, expected life, dividend yield, and strike price. If vesting or performance conditions exist, I adjust fair value or probability of vesting. While answering, always talk about model parameters, vesting adjustments, probability factors, fair value accuracy. A firm has unreliable financial statements. How do you approach valuation with incomplete data? Sample answer. I reconstruct financials using bank records, GST returns, management interviews, and industry benchmarks. I apply wider valuation ranges due to higher uncertainty. While answering, always talk about data triangulation, reconstruction methods, uncertainty, wider valuation band. How do you calculate and interpret EV/EBITDA versus EV/EBIT multiples? Sample answer. EV/EBITDA ignores depreciation and suits asset-light sectors, while EV/EBIT incorporates CAPEX needs, and suits capital-intensive industries. Interpretation must align with business model. While answering, always talk about depreciation impact, asset intensity, sector relevance, comparability. Evaluation is being done for regulatory purposes. How do you ensure compliance with ICAI IVS guidelines? Sample answer. I document assumptions clearly, justify methodology choices, reconcile multiple approaches, and include sensitivity analyses. I ensure disclosures follow ICAI IVS standards precisely. While answering, always talk about documentation, compliance alignment, transparency, audit-ready models. How do you present valuation findings to investors or the board? Sample answer. I summarize key drivers, show valuation range, highlight sensitivities, and explain assumptions in simple language. I avoid technical overload and present implications for decision-making. While answering, always talk about clarity, valuation range, driver summary, decision impact. A transaction involves earnouts linked to future performance. How do you incorporate earnouts into valuation? Sample answer. I model probability-weighted payouts based on forecast achievement. Earnouts are discounted to present value and added to enterprise value or purchase consideration. While answering, always talk about probability weighting, payout modeling, discounting, linkage to performance. Thank you for watching, and if you liked our video, kindly press the like button and leave us a comment. This will help us reach a wider audience. Don't forget to check the playlist for more great learning.